Traders are really going to remain on edge today, looking for any further BOJ currency intervention. There's also going to be a pretty keen eye on a speech today by the RBA Assistant Governor Philip Lowe entitled The Development of Asia, Risk and Returns for Australia. Let's bring in Stephen Nash, who joins us now from FIG Securities. Stephen, this is yet another key speech at lunchtime today from Philip Lowe. What exactly is the market looking for, though?
I think what the market wants and what the market gets are going to be two different things. What the market wants, I think, is comments on monetary policy. I think this will probably be a fairly broad speech, but I think the important thing will possibly be comments on the assessment of Asian growth at this stage. I think that's a really key indicator and important benchmark for the RBA.
Why?
Is that a pretty easy assessment? Things are good.
That's exactly pretty much was my question.
Well, I think what the market's looking for is whether the RBA anticipate growth to be on the downward path or moderating further from here, or whether they anticipate a renewed increase in growth. They have commented recently that they've seen a moderation in growth, and I think that's positive for those who are looking for no rate rise at this stage.
Yeah, because this would obviously feed into the global outlook for the RBA. Where do you think the market is looking right now in terms of interest rates?
Well, the market a few weeks ago had built in the possibility of an easing by the RBA, but that's been reversed with the spate of recent releases. We had the GDP, the employment numbers quite strong. So we've had a sort of a series of releases. But yesterday we had the Westpac Consumer Confidence. That indicated that the consumer was a little bit more wary than people would have expected with the other releases. I suppose it's led to a more balanced view of what's going on. It's only one of the indicators, I suppose, a second-tier indicator, but it sort of balances the picture a lot more.
And today marks the issuance of this federal government 20-year inflation-linked bond. Now, from what I understand, that the fixed income space, a small round of applause for this thing kicking off.
Yes, well, the inflation-linked market had been closed for a long time. They reopened it with the 2025 in November last year. And this is an extension of the duration of the inflation-linked market. So there's quite a large demand for these particular securities. Hopefully they can extend again and possibly use the inflation-linked market as a way to extend duration in the inflation-linked market first, and then hopefully follow that with nominal bond issuance. As you know, the coalition supported the idea of a 30-year nominal bond. I think that's a great idea, and I think we should really investigate that.
Because you have talked to us for such a long time about that whole new investment landscape for those long duration bonds. So you think this is kind of a step towards that? Step
in the right direction? Yes, definitely, yes. People have long-term liabilities, and these assets really help them match those liabilities.
Have you seen any flow-on effects from the inflation-linked bond, the 20-year one that James was mentioning? The
Commonwealth issuance may create some imbalances in other government areas. For example, the T-Corp issue. There may be people looking to sell from an institutional point of view, sell a few semis to buy the Commonwealth bond today. So T-Corp have accommodated that with a reverse tender for their particular securities, basically looking after investors. It's a positive move by T-Corp. They're one of the few semi-government authorities that have committed to the inflation-linked market, and they've been very committed, and I think what they're looking for is a larger asset allocation to this space, and hopefully that will come.
What did you make of earlier this week Macquarie's sub-issue? I suppose some question marks over the size of it.
Yeah. I think the size of it indicates that they anticipate, like a lot of others, that there will be a lot of competition in the European market going forward. There's been a lot of hold-ups, European sovereign debt crisis and other issues holding issuers up in terms of their programs. So the need to get a large issue away, I think, was important for the bank. I think the pricing was probably adequate. It wasn't really a surprise, but I think it just highlights that competition for funding, and that will affect Australian bank funding going forward, I think.
Are we likely to see more of these sorts of things as some banks try and catch up with these new Basel III capital requirements?
I think we'll just see more issuance of bonds generally, but I think the implication from the Basel III is that some of the callable issues that are in the secondary market at the moment may be a little bit better bid, as the certainty of call is somewhat increased with these new rules. In other words, the banks, it'll be more expensive for the banks not to call the issues rather than, yeah. to leave them alone.
And one final and very big question as well, Stephen, for you, is quantitative easing in the United States. Goldman Sachs says November, it's happening. The market's kind of going along with this idea that eventually it will happen even in the next couple of months. Why is that developing?
Well, I think you've seen a general acknowledgement of a weakening or deceleration of growth in the US. I think the Fed is looking for some data to prompt that. We've had a little bit of weaker data last night, as you mentioned, but I don't think that will be adequate. But I think the administration is also very interested in stimulating growth. They basically want to avoid any question of a double dip. So I think, yeah, I think I would probably agree with that quantitative easing will emerge. We just really need a piece of data to prompt that.
I heard a figure, though, estimate of $1 trillion in terms of QE from the Fed. I mean, would that sound about the right sort of ballpark?
Well, to some extent, the Fed is jawboning the market. By talking about it, they bring rates down in the long end. And with long rates going down, it's very important because you're getting reductions in mortgage rates. And that's stimulating some interest in the housing market, which is very important, I think, going forward.
Stephen Nash, thank you so much for coming in yet again. We'll see you soon. Appreciate that. Stephen Nash there from FIG Securities.